The last time a company with 3 billion users tried to launch its own digital currency, the United States government didn't just push back. It mobilized central banks, finance ministers, and regulatory bodies across 4 continents to kill it before it went live. That was 2019. That company was Facebook. It's now 2026, and Meta is back at the table, this time with a stablecoin. A completely different regulatory environment, and a political class that just passed legislation that makes what they're doing entirely legal. So the question isn't whether this is going to happen. It already is. The question is, what does it mean for Bitcoin, for institutional capital, and for every investor watching this right now who thinks they've already figured out the crypto landscape? Welcome to the Wealth Continuum. I'm going to move fast today because this topic has more layers than most analysts are willing to sit with. Let me put 3 questions on the table right now, and I'm going to leave them open for the first half of this video because the honest answer to each one depends on context that most people skip over. Question 1. Is Meta's stablecoin a genuine threat to Bitcoin's monetary narrative, or is it the most powerful adoption accelerant the crypto ecosystem has ever seen from a non-crypto entity? Question 2. When 3 billion monthly active users suddenly have access to a dollar-pegged digital asset embedded inside. WhatsApp, Instagram, and Threads. What actually happens to liquidity across all digital asset markets, including Bitcoin? Question 3. And this one is the most uncomfortable. If Meta controls the rails of a stablecoin at global scale, have we just handed the most powerful private surveillance infrastructure in human history a direct line into the transaction layer of the internet? I'm not going to answer those questions yet. I want you to hold them because how you answer them will determine whether you see this development as the most bullish macro signal for crypto in a decade, or as the first credible threat to everything Bitcoin was built to oppose. Let's start with what actually happened. In early 2025, multiple credible outlets, Fortune, the Financial Times, and Bloomberg, reported that Meta had quietly been holding internal discussions about reintroducing a stablecoin payment infrastructure. This wasn't a relaunch of Diem. This was architecturally different, and the distinction matters enormously. Diem, which began its life as Libra in June 2019, was designed as a basket-backed synthetic currency, a move so sweeping that it would have competed directly with sovereign monetary policy. Jerome Powell called it a potential threat to financial stability. Christine Lagarde called it a threat to monetary sovereignty. The G7 issued a joint statement opposing it. That project was abandoned in January 2022, and Meta sold its assets to Silvergate Capital for approximately $200 million. What Meta is exploring now is not that. What they're reportedly building is a US dollar-pegged stablecoin, operating within existing reserve requirements, designed initially for low-value cross-border payments and creator monetization flows. Specifically, the use cases being discussed internally center on paying content creators in international markets, particularly in Southeast Asia, Latin America, and Sub-Saharan Africa, where dollar access is constrained and traditional wire infrastructure is expensive and slow. On the surface, this looks like a payments utility play, and that framing is exactly what Meta wants you to focus on. But here's where institutional investors should stop and apply a different lens. Visa processes approximately 200 billion transactions per year. PayPal has around 430 million active accounts. Meta has 3.27 billion daily active users across its family of apps as of Q4 2025. If even a small fraction of Meta's user base begins holding and transacting in a Meta-native stablecoin, we're talking about a payment network that would dwarf every existing financial rail, including SWIFT, in terms of addressable reach within 3 to 5 years. And critically, this is happening under a US regulatory environment that, for the first time in crypto's history, is explicitly accommodating. The Genius Act, the Guiding and Establishing National Innovation for U.S. Stablecoins Act, passed the Senate Banking Committee in March 2025 with bipartisan support. It creates a federal framework for stablecoin issuers, reserve requirements, redemption rights, audit standards. It effectively legitimizes private stablecoin issuance at scale. For the first time, a company the size of Meta can pursue this without operating in a legal gray zone. The political environment that killed Libra in 2019 no longer exists. Think about that for a moment. The regulatory wall that stopped Meta 6 years ago has been dismantled, not partially, structurally. I want to pause here because I think there's a temptation at this point in the analysis to jump straight to the Bitcoin question. And I understand that impulse. Most of you watching this are either long Bitcoin or managing exposure to it. But let's resist that for a few more minutes because the institutional capital angle is actually where this story gets genuinely complex. When BlackRock filed its Bitcoin ETF application in June 2023 and it was approved in January 2024, it represented something specific: institutional capital gaining a compliant on-ramp to Bitcoin as a store of value asset. As of February 2026, spot Bitcoin ETFs in the United States hold collectively north of $60 billion in assets under management, with BlackRock's IBIT alone sitting above $50 billion. That is not retail speculation. That is pension funds, family offices, endowments, and RIAs allocating to Bitcoin through a regulated wrapper. Now layer Meta's stablecoin on top of that. Here's a scenario that most analysts are not modeling. If Meta successfully launches a widely adopted dollar-pegged stablecoin, it creates a global permissionless dollar layer inside the most used communication applications on Earth. In developing markets especially, this becomes the first frictionless dollar account that hundreds of millions of people have ever had access to. And here is where Bitcoin intersects in a non-obvious way. Historically, stablecoin adoption has been a precursor to broader crypto adoption. When Tether and USDC became the dominant liquidity instruments on centralized exchanges, they didn't cannibalize Bitcoin. They built the on-ramp infrastructure that made holding and trading Bitcoin accessible. The stablecoin market capitalization, currently sitting at approximately $225 billion across all chains as of February 2026, has grown alongside Bitcoin's market cap, not in opposition to it. If Meta's stablecoin follows that pattern at a dramatically larger scale, and that's a big if, which we'll get to, it doesn't pull capital away from Bitcoin. It creates a population of digitally fluent dollar holders who already live inside an app ecosystem where, in theory, one additional tap could expose them to Bitcoin, Ethereum, or any other digital asset. That's the adoption acceleration scenario. But institutional investors should be thinking about the second-order effect on liquidity, and that's more complex. The total global remittance market processes approximately $860 billion annually, according to World Bank data from 2024. The average cost of sending remittances internationally is still around 6%, despite 2 decades of fintech innovation. Meta's stablecoin, if deployed at scale in key corridors, the United States to Mexico, the United States to the Philippines, the Gulf to South Asia, could capture a meaningful share of that market within 24 to 36 months. Here's the institutional implication. When remittance flows shift to a Meta-controlled stablecoin rail, they stop running through correspondent banking networks. They stop generating transaction data for SWIFT, and they begin generating transaction data exclusively for Meta. If you're an institutional investor with exposure to traditional financial infrastructure, payment processors, wire transfer networks, currency exchange businesses, that's a material structural risk that is not yet priced into most portfolios. And if you're an institutional investor with exposure to Bitcoin as a censorship-resistant store of value, the question you need to be asking is whether Meta's stablecoin increases or decreases the perceived need for that specific value proposition. I'm still not going to answer that directly, but I want you to sit with the tension in that question. Let me ask you something directly. Drop it in the comments. Do you think Meta's stablecoin is more likely to replace Bitcoin's use case or accelerate the path toward it? I read these, and the distribution of answers in this community is genuinely one of the better indicators of where sophisticated investor sentiment is sitting right now. Before I go into the centralization risk and the contrarian perspective, because those 2 sections are where this analysis gets most uncomfortable, I want to take 45 seconds. If you're watching this channel and you're not already subscribed to the Wealth Continuum, this is the moment to change that. Not because of the standard macro commentary, you can find that anywhere, but because over the past few months we have been ahead of the stablecoin regulatory arc, ahead of the ETF inflow story, and ahead of the institutional onboarding curve. The analysis that goes into this channel gets published in deeper data-driven form in the newsletter each week. The link is in the description. It's free to start. And if the level of rigor in this video reflects what you're looking for in your financial media diet, I'll let the work speak for itself. Now, the centralization problem, because this is where I think most retail-facing coverage of Meta's stablecoin completely falls apart. Let's be precise about what a Meta-issued stablecoin actually is at the architectural level. A stablecoin issued by Meta is a liability of Meta. That means when you hold Meta's stablecoin, you are holding a digital claim on Meta's balance sheet, backed by whatever reserve assets Meta holds, presumably short-duration U.S. Treasuries and cash equivalents, as the Genius Act would likely require. You are not holding money, you are holding a promise from Meta to give you money. That distinction is not semantic, it is fundamental. Compare that to Tether's USDT or Circle's USDC. These are also centralized stablecoins. They can freeze wallets, reverse transactions under legal order, and comply with OFAC sanctions lists. They already do this. That is a known and accepted limitation of dollar-pegged stablecoins operating under U.S. law. But here's what makes Meta qualitatively different from Circle or Tether. Meta knows who you are, not just your wallet address, your face, your friend network, your location history, your purchase behavior, your messaging content. In jurisdictions where that data is legally accessible to Meta, When you transact with a Meta stablecoin inside WhatsApp, you're not conducting a pseudonymous transaction on a neutral ledger. You are conducting a fully identified transaction inside a platform that has more behavioral data on its users than any entity in human history, including most governments. The transaction graph that Meta would build from stablecoin payments would be an unprecedented surveillance asset, not hypothetically, structurally. And here is where the institutional risk calculus becomes genuinely difficult. If Meta is stablecoin achieves even 10% penetration of its daily active user base as a payment instrument, that's roughly 327 million people. Meta gains a financial transaction data set that traditional banks have spent decades trying to build, and that credit card networks have always only partially captured. The analytical and advertising monetization potential of that data set is worth potentially more than the stablecoin payments business itself. This is not paranoia. It is a straightforward extension of Meta's demonstrated business model. Now here is where the Bitcoin question becomes sharper. Bitcoin's core value proposition, as articulated by its most rigorous advocates, and I mean people like Lynn Alden, Michael Saylor, and the researchers at institutions like Fidelity Digital Assets, is not primarily that it is a superior payment system. It is that it is an asset whose issuance schedule, transaction history, and ownership cannot be controlled or surveilled by any single entity. The protocol is apolitical. The ledger is public but pseudonymous. Confiscation requires physical access to private keys. Meta's stablecoin is, at the architecture level, the precise opposite of that. It is maximally surveillable, maximally controllable, and maximally subject to government compulsion. If Meta is ordered by the US Treasury to freeze the stablecoin wallets of citizens in a sanctioned country, Meta will comply. If Meta is ordered to report all transactions above a certain threshold to the IRS, Meta will comply. If Meta is pressured to delist certain payment recipients, political dissidents, controversial media organizations, entities that violate community standards, Meta has the technical capability to act on that pressure with a precision no traditional bank can match. That is not a bug in Meta's stablecoin. That is a feature from a regulatory compliance perspective. And it is exactly why regulators are now comfortable with it in a way they never were with Libra. But from a censorship resistance standpoint, the standpoint of investors who understand why Bitcoin exists, it makes Meta as stablecoin not a Bitcoin competitor, but a demonstration of exactly what Bitcoin is designed to be an alternative to. And I think that's where the analytical split in this conversation actually lives. Here's a thought experiment I want you to sit with, and tell me your answer in the comments. If a government with an authoritarian lean, not hypothetical, pick one that currently exists, gained the ability to pressure Meta to freeze or monitor stablecoin wallets for its citizens, do you think that government would use it? And if your answer is yes, does that change how you think about Bitcoin's risk premium as an asset class? Let's move to the liquidity implications, because this is where the institutional analysis diverges most sharply from the typical retail commentary. The stablecoin market has a liquidity architecture problem that most investors don't appreciate. As of February 2026, the top 3 stablecoins by market cap are USDT at approximately $140 billion, USDC at approximately $48 billion, and DAI-adjacent instruments in the $10 to $15 billion range. The vast majority of stablecoin liquidity sits on Ethereum and Tron, with significant presence on Solana and newer L2 networks. This liquidity is largely captive to crypto-native infrastructure. It circulates within DEX, centralized exchanges, lending protocols, and DeFi yield strategies. When institutional investors move capital through stablecoin rails today, they're still predominantly doing it within the crypto ecosystem's own plumbing. Meta's stablecoin changes the architecture of where dollar-denominated digital liquidity lives. If Meta's stablecoin is issued on a proprietary infrastructure, or even on a permissioned chain like what Diem was initially designed around, it would create a massive pool of dollar-denominated digital liquidity that does not natively connect to existing DeFi or crypto exchange infrastructure. That liquidity would be walled inside Meta's ecosystem. This has 3 specific implications for institutional investors. First, it fragments the stablecoin market. Right now, USDC is the institutional-grade stablecoin of record. It's integrated with Coinbase, trades on every major platform, and is the dominant instrument for institutional on-off ramps. If Meta creates a competing dollar instrument with 300 million users, but no interoperability with existing crypto infrastructure, you have 2 parallel dollar digital ecosystems that don't talk to each other efficiently. That creates friction, arbitrage opportunities, and potentially systemic risk if Meta's reserves ever come into question. Second, it changes the competitive dynamics for Circle and Tether. Circle has been positioning USDC as the compliant, regulated stablecoin for institutional adoption. Meta's stablecoin if structured under the Genius Act framework, would effectively compete directly with USDC for the compliance-driven market while also having distribution that Circle can never match. This is an existential competitive dynamic for Circle's standalone business case, and it has direct implications for anyone holding equity in stablecoin-adjacent businesses. Third, and this is the most important one for Bitcoin specifically, if Meta's stablecoin captures a meaningful portion of the remittance and international payments market, it begins to siphon off one of the use cases that has historically been an on-ramp to Bitcoin. In markets like El Salvador, Argentina, and Nigeria, Bitcoin has gained adoption partly because it's a dollar-accessible, bank-independent store of value in environments with currency instability. If Meta offers a simpler, cheaper, more accessible dollar instrument inside an app people already use, the practical case for Bitcoin as a payments or savings instrument in those markets weakens, at least at the margin. But here is the counter-argument, and this is important. Bitcoin's adoption in those markets has not primarily been about payments. It's been about the inability to trust local financial institutions. Meta is a foreign technology company with a documented history of data misuse, censorship, and politically motivated platform decisions. In markets with high institutional distrust, it is not obvious that a Meta stablecoin carries more credibility than a Bitcoin wallet held in self-custody. I promised you a contrarian perspective, and here it is. Meta Platform's stablecoin may actually strengthen Bitcoin's long-term monetary narrative rather than weaken it. Here's the logic. Every time a large centralized platform introduces a widely adopted digital dollar, two things happen at the same time. First, it normalizes the idea of holding digital value. That has historically been one of the biggest psychological barriers for new users entering crypto markets. Second, and this is the part most analysts underestimate, centralized digital money systems eventually expose their limits, restrictions, compliance controls, geographic constraints, or policy enforcement. When that happens, the case for decentralized alternatives becomes clearer. We've already seen a version of this dynamic. When PayPal launched crypto services in 2020, many assumed it would reduce demand for independent crypto platforms like Coinbase. Instead, PayPal became an on-ramp. Millions of users were introduced to digital assets, but because the system was custodial and limited, serious users eventually migrated towards self-custody and broader crypto ecosystems. PayPal didn't replace Bitcoin adoption. It accelerated it. Meta's stablecoin could function the same way, but at far larger scale. With billions of users inside Meta's ecosystem, a massive number of people, especially in countries with currency instability, will experience digital dollar accounts for the first time. But those balances will still operate under Meta's terms of service, regulatory obligations, and platform controls. That discovery is powerful because the strongest argument for Bitcoin has never been its technology alone. It amps the behavior of centralized institutions. Every time a payment platform restricts transactions, every time compliance rules override user control, every time digital money proves to be conditional rather than sovereign, the demand for decentralized monetary alternatives increases. This leads to the contrarian conclusion. Meta's stablecoin is more likely to strengthen Bitcoin's long-term narrative than compete with it directly. Now, let's close three key strategic questions. First, is Meta's stablecoin a threat or an adoption accelerant? Short-term, it could compete with crypto payment use cases in developing markets, but long-term, the evidence leans toward adoption acceleration because exposure to digital dollars historically precedes exposure to decentralized assets. Second, what happens to liquidity across crypto markets? That depends on interoperability. If Meta builds a closed ecosystem, which is likely at launch, liquidity stays internal. But over time, simply normalizing digital asset behavior at scale reduces friction for users moving into broader crypto markets. That's a long cycle effect. Think 5 to 10 years. Third, does this create a new financial surveillance layer? Yes, structurally. A digital currency embedded inside. Meta's data ecosystem becomes one of the most powerful financial data environments ever created by a private company. That doesn't automatically make it negative, but it does reinforce why decentralized assets exist in the first place. For investors, this matters. If Bitcoin is part of a portfolio as a censorship resistance hedge, then large-scale corporate digital currencies should be viewed as real-world validation of that thesis, not contradiction. From a business standpoint, Meta's opportunity is enormous. If digital payments scale across remittance corridors, the revenue impact over a decade could be massive. And importantly, Meta succeeding commercially does not weaken decentralized monetary demand. Financial history repeatedly shows that when centralized monetary systems expand, alternative systems tend to gain asymmetric interest. Here's the takeaway. The investors who navigate the next decade successfully won't be the most bullish or bearish. They'll be the ones who understand how regulation, technology, and monetary design are converging in real time. In the next video, we're going deeper. What happens if 3 private stablecoin ecosystems emerge? Meta, PayPal, and a potential Apple Inc. instrument, and how that scenario interacts with the global role of the Federal Reserve. Stay analytical. See you in the next one.